a rule most retirees never hear explained in plain English just fired on April 1st. And if it hit you, it can trigger a penalty that feels like legalized theft. If you turned 73 at any point in 2025, the IRS expected you to take your first required minimum distribution, RMD, from certain retirement accounts no later than April 1st, 2026. That date has now passed. And if you missed it, here's the ugly part. The government can charge an excise tax of up to 25% on the amount you should have withdrawn, the shortfall, on top of the normal income tax you'll still owe when you take the distribution. But there's good news most people never get told. In many cases, you can make that penalty go away by correcting the mistake fast and filing one short IRS form the right way. Before we get to the fix, you need to understand 3 other retirement tax traps that have been quietly catching people because they connect to the same mistake: taking money out at the wrong time, in the wrong way, with the wrong expectations. First, the RMD penalty you just triggered and what it really is. Let's be precise because wording matters. The IRS is not taking 25% of your whole retirement account. The penalty is 25% of the RMD amount you missed. Example, if your required withdrawal was $10,000 and you took $0, the shortfall is $10,000. The excise tax can be $2,500 plus the regular income tax when you eventually withdraw the money. And yes, the law used to be worse. That penalty used to be 50%. It was reduced generally to 25% under recent law changes. In some situations, if you correct the mistake fast enough, it can be reduced further. And there's also a reasonable cause waiver pathway that can erase it completely. Now here are the 3 other traps retirees keep stepping into, often because nobody warns them until after the damage is done. Trap number 1, the Social Security tax gotcha that was built for the rich but now hits millions. A lot of retirees believe Social Security shouldn't be taxed because they paid in for decades. That's emotionally understandable. But the law doesn't work that way. The IRS uses something called combined income to decide whether your Social Security becomes taxable. Combined income generally equals your adjusted gross income, AGI, plus tax-exempt interest, plus half of your Social Security benefits. Then the thresholds kick in. For single filers, $25,000 to $34,000, up to 50% of benefits can be taxable. Above $34,000, up to 85% can be taxable. For married filing jointly, $32,000 to $44,000, up to 50% taxable. Above $44,000, up to 85% taxable. Here's what makes people furious when they learn it. Those thresholds were set decades ago and were never indexed to inflation. So what was once aimed at higher income retirees now hits a much bigger share of people, especially anyone taking IRA withdrawals. And here's the sneaky part. Even a small increase in income or even a cost of living bump can push you across a line where more of your benefits become taxable. Then the tax bill eats the raise. Trap number 2. The senior deduction people miss because it's easy to overlook. Even under current law, many older filers qualify for an additional standard deduction just for being age 65 plus. It's not a coupon, it's real money that reduces taxable income, and people miss it because they don't check the right boxes or their preparer software doesn't apply it correctly. Action item: when you or your preparer completes the return, make sure the return correctly reflects your filing status, and that you and your spouse, if applicable, are 65 or older, so the additional deduction is applied properly. If you already filed and something looks off, an amended return, Form 1040X, is the usual path to correct it. Trap number 3, the inherited IRA 10-year rule that blindsides families. If you inherited a retirement account in recent years, the rules are very different than they used to be. For many non-spouse beneficiaries, the old stretch IRA approach was replaced with a rule that often requires the account to be emptied within 10 years. And depending on the situation, especially if the original owner had already started taking RMDs, there can be additional annual distribution requirements inside that 10-year window. This is where people get hammered because they don't know they were supposed to take anything until year 10, then they learn penalties may apply for earlier years. The important part here isn't the fine print, it's the warning. If you inherited an IRA, don't assume it's on autopilot. Log in, read the beneficiary rules for that specific account, and confirm whether annual withdrawals are required. Now back to the big one, the April 1st RMD deadline that just passed and how to erase the penalty. If you missed an RMD, here's what matters most. 1. Fix the shortfall immediately. Take the missed RMD amount as soon as possible. The faster you correct it, the better your position typically is. 2. Document what happened. The IRS waiver process often hinges on you being able to say why it was missed and what you did to correct it. Common reasonable cause explanations people use include illness, hospitalization, death in the family, confusion after retirement, account custodian error, advisor error, moving, or simply not understanding the rule applied. 3. File Form 5329. The form used to report and often request relief from retirement account excise taxes is IRS Form 5329. This is the key move. Form 5329 can be used to request a waiver of the excise tax for a missed RMD when you can show reasonable cause and you've corrected it. Important, depending on your situation, you may file Form 5329 with your timely filed return or an amended return if you already filed. Also important, if the IRS has already assessed the penalty and started collection action, it can become harder. That's why the Act Now part is real. If you want the cleanest path, correct the distribution first, then file the form properly with a short statement. One powerful strategy that can prevent multiple traps at once, the QCD Now. For a tool that can save retirees real money, especially people who are charitable anyway. If you're 70 and a half or older, you may be able to do a qualified charitable distribution, QCD, from an IRA. The IRA custodian sends money directly to a qualified charity. It can count towards your RMD, and because the money never hits your bank account as personal income, it may not show up the same way in taxable income. That can help you satisfy the RMD, avoiding missed RMD penalties, reduce taxable income that can trigger Social Security taxation thresholds, keep income lower for other phase-outs and tax calculations. The annual QCD limit is set by law and has been indexed for inflation in recent years, so the exact cap can change. Your custodian can confirm the current year maximum. Final note, because this topic is sensitive, this is general information, not individual tax advice. If you're dealing with a missed RMD, inherited IRA rules, or Social Security taxation, getting a qualified tax pro involved can save you far more than it costs. Here's the practical checklist. Get the correct prior year tax forms for tax year 2022. Do not use today's form and guess. You need the 2022 version because rules, deductions, and brackets are year specific. Gather anything you still have from 2022, W-2s, 1099-R forms, retirement distributions, 1099 INT, bank interest, SSA statements, brokerage forms, anything. If you can't find documents, request your 2022 wage and income transcript from the IRS transcript system. That's the catch-all record of what was reported to the IRS under your name for that year. Prepare the 2022 federal return using 2022 instructions. If your situation is simple, it may be straightforward. If it's not simple, get help from a qualified preparer because the deadline matters more than pride right now. Sign it and mail it to the correct IRS address for prior year returns. The address depends on your state. Older year returns often must be mailed as paper. The envelope must be postmarked by April 15, 2026. The postmark date is what matters. A late postmark can mean a permanent loss even if the IRS receives it quickly. And here's the most important part. Do this not just for yourself, but for someone older in your family. Call a parent, grandparent, aunt, uncle, neighbor, any senior who doesn't file anymore. Ask one simple question. Did you take any retirement money, cash any bonds, work part-time, or have taxes withheld in 2022?